everyone, and welcome to this wealthmanagement.com Fast Chat. I'm Shannon Rossic, and I'm joined by Dr. Bruce Kahn, lead portfolio manager of the Shelton Sustainable Equity Fund, which the ticker symbol is NEXTX. Dr. Kahn, thank you so much for joining me for this conversation.
Well, thank you for having me.
Absolutely. And we'll be taking a fast but a deep dive into navigating the sustainable investing landscape in 2024. So let's dive right into this. Why is sustainable investment and ESG integration so critical for investors today?
Well, the ESG and sustainable investing integration has always been critical. What makes it even more paramount today is more and more corporations have been committing large aspects of their budgets to capital expenditures that are making their companies more sustainable. So paying attention to that fine detail of what companies are putting money to work in is why it's so important to integrate today. In the past, it had mostly been about grading or negative screening. Today, it was really evolved to kind of table stakes for any investor to be paying attention to what companies are doing on the sustainability front.
So how is this style of investing then different from focusing on conventional or traditional methods of asset valuation?
It isn't. Any analyst worth their salt over the past 30 years has been paying attention to this, and those who don't kind of end up with mediocre or average results. The reason why I say that is because most companies are doing more and more activity today. And so if you're not really paying attention to it, then you're going to miss some important nuances. Now, what ESG or sustainable investing, it's gotten lost in the vernacular today in the latest political uproar. But what it really is like taking a zoom out. Let's zoom out and look at the context of the company, where it's operating, how it's operating, it's licensed to operate, and then zooming in on a particular set of details that are catching the trend of becoming more energy efficient or more socially aware of their employees and their stakeholders. So those kinds of nuances, weren't really paid attention to the conventional analyst pool, but that is changing. And so we think that this becomes just table stakes as a way of investing.
So we obviously have to talk about risk, though, when it comes to sustainability and ESG. Are those risks the same as financial risks? And if so, how? And if not, why consider them then at all?
So risk is an interesting word because risk is something you don't know you have until you have it. And sustainability risks ultimately become financial risks. So there are conventional financial risks like volatility of the stock market, or the particular trend in that particular stock, or what particular officers of that company are doing in terms of their exercising their options. Those types of things are kind of conventional and people watch out for them, or broader market risks that are happening, like there's a tariff blocking Chinese goods coming to the Americas. Like everybody's going to be paying attention to that. But what makes sustainability risks unique is the foresight of saying, well, how about this region of the world? What is the kind of, for an example, what is the water resource, like, for example, in Colorado looking like? Companies building manufacturing in Colorado, which is having trouble with its water resources. A conventional analyst might not have considered that, but a sustainability analyst certainly would. The challenge, of course, is connecting the sustainability analysis to the financial analysis. And oftentimes what kind of our part of the industry has done is separated those two mechanisms. There's the sustainability analyst and the shareholder engagers, and then my hands are in the camera. And then there are people who are on the investment team, and they kind of maybe talk once a week. What's really the most advanced way of doing this today is that it's completely integrated into every team.
So is sustainable investing a separate asset class? Or ultimately, how should it be viewed across an asset allocation policy then?
It's not a separate asset class. Heretofore, it has been kind of either put in one bucket as like, oh, that's the green investing versus everything else, and then they would cancel each other out. Or there would be certain mandates managers would have from certain asset owners. Oh, we're going to screen out some sector for some particular mandate. But overarching asset allocation, sustainability as a risk and return factor should be incorporated into any manager and into any manager search and any asset allocation policy.
So what are the tailwinds and headwinds for sustainable investing? And given those, what are the expected returns and risk profile of this style of investing for 2024 and even beyond?
Yeah. Right now, we are in a very unique spot about headwinds and tailwinds and some crosswinds. So the headwind is just market attention to other areas of the economy, such as AI and technology and computer technology. Those are great. That's a great theme in the mega cap, large cap kind of IT sector. But those tools that those companies are all developing are going to be used across the entire economy. Okay. So that's a bit of a headwind for markets. Tailwind is that the United States has put at least $1 trillion, if not more, depends on how you ask, of subsidies and tax credits behind the transformation of our economy to becoming lower carbon and greener and cleaner. That adds jobs, adds manufacturing, and adds more made in America content to the U.S. economy. So that's the tailwind. The crosswind is kind of like some of this noise we've seen in the past 18 months about, oh, ESG and sustainability is kind of like woke capitalism. I mean, it's just noise, but there is a little crosswind because it does make people pause and go, well, is my manager who claims to be doing sustainable investing actually doing it? And so it is incumbent upon advisors and asset owners to evaluate the managers that they're using to capture this, once in a century kind of transformation of our economy on the same scale as the transformation of the U.S. economy when President Dwight Eisenhower signed the Interstate Highway Bill back in the 50s. I mean, that was tremendous. This is also tremendous.
Well, I'm certainly stealing the terminology woke capitalism moving forward.
I'd rather be awake than asleep, whether I'm driving or throwing, making investments on behalf of our clients.
Absolutely. And just to give our listeners some context, can you just quickly explain the Shelton Sustainable Equity Fund, the NextX?
So NextX is a mid-cap growth fund. It sits squarely in the mid-cap growth asset class. We are capturing the opportunities. About 80% of the investments are clearly oriented towards sustainability, whether that be clean energy, clean water, advanced agriculture, manufacturing, high performance buildings, everything that the Inflation Reduction Act is supporting. Another 20% of the fund is, because we're a diversified fund, we have other areas such as healthcare and education in the portfolio, and some IT as well. But it sits squarely right in the mid-cap growth asset class, and we're primarily domestic. I mean, we have some international, but primarily domestic.
Well, I appreciate the context, and I know that we will all certainly be watching the crosswinds around sustainable investing throughout 2024. So, Dr. Kahn, thank you so much for your insights. They are much appreciated.
Thank you, Shannon.